Stocks closing at record highs today after the Fed held rates steady and maintained the rate cut outlook. Joining us now, former Boston Fed President Eric Rosengren. It's great to have you back on the show. It's interesting. On the one hand, you have an SEP that showed fewer rate cuts in the coming years, meaning 2025, 2026, even though the dot plot reiterated 3 this year. On the other, you have balance sheet runoff that's maybe poised to slow, quote unquote, fairly soon, which David Zervos earlier in the hour said was really the biggest news from this meeting today. Your thoughts?
Yeah, I would agree with that. I don't think there's much of a surprise in today's news. I think Fed speeches have made it pretty clear that they were looking to keep 3 rates this year, which is what they had expected at the December meeting, which is the last time they provided a forecast. In terms of their forecasts, I think what's notable is they have upgraded their forecast for growth of real GDP for this year and basically see 2% growth for each of the next this year and the next 2 years. So that's an upgrade from where it was. So basically what they have in their forecast is a perfect soft landing with an economy that is strong enough that they don't feel that they need to bring down interest rates particularly quickly. And so, as you said, they have 3 cuts in each of the next 3 years. And they also increased what they thought the Fed funds rate would be in the long run by only 0.1% to 2.7. I do expect over time that will drift up. But I'm not surprised that it is quite likely that they will be continuing to discuss what's happening with the balance sheet. And I would expect that they will be reducing how quickly the balance sheet shrinks over time.
You know, quantitative tightening was sort of seen as this unprecedented experiment. And there were some questions raised, at least within the Wall Street community, about do we really know how this is going to impact the market? Now that it seems to be poised to come to an end or at least slow down, do we know what the impact of that is going to be?
So I don't think we know, but the program's been designed not to have much of a market impact. So the goal since implementation of quantitative easing and then quantitative tightening has, with the quantitative easing, you're trying to change markets and trying to have an impact on interest rates. With quantitative tightening, you're trying to do it gradually enough that there's no noticeable effect. And I expect that if they're successful, that there won't be that much impact on markets basically by design. They can reduce the amount that they have run off, and then at some point further into the future, they again can just be growing the balance sheet as fast as the liabilities on the Fed's balance sheet are growing.
So I'm going to ask a question that I feel like we've been asking on CNBC for the better part of a year and a half, but it warrants it again, and that is, why is the U.S. continuing to hold up so well with rates so high?
Yeah, I think there are a couple aspects to that. Normally, to have a weaker economy with higher interest rates, 2 places I would be looking. The first is construction, and construction employment has continued to be quite strong. And I think part of that reason is because fiscal policy has provided quite an incentive for construction, not for things like the typical commercial real estate like towers in downtown cities, but in terms of chip manufacturing. So manufacturing construction has been quite strong. Highways have been quite strong. So a lot of the infrastructure and power has been quite strong. All those have been affected by some of the legislation that we've seen over the last 2 years. So I think fiscal policy have offset some of the weakness we would normally see in interest-sensitive construction. I think the second is that consumers continue to be more comfortable with taking on debt than many people would have expected. So the second place I would have looked for weakness in the economy would be something like auto sales. But auto sales have held up quite strongly, despite the fact that auto rates are quite high and that sales prices have continued to be high, though there's a little bit of softening there. So if you have pretty strong auto sector and a pretty strong construction, that's where you would expect to see the interest rates bite. And so in effect, there've been some offsetting conditions basically between fiscal policy and some of the post-pandemic consumer behavior.